Hello everyone and welcome to the channel, and let's get right into today's main event. An overview of how to analyze a real estate investment proposal. A real estate developer or sponsor will put together an offering memorandum with some basic information about the project. As you read through the memorandum, keep in mind the following points. Who is the developer? What is their track record? Did they do similar projects in the past? Are they knowledgeable about the market? And are they easy to deal with? Do they provide information promptly? Then understand what the project is all about. Where it's located. Would you want to invest in that location? What is the scope? Is it a ground up or value add / renovation? What is the time frame for the project? A project could take between a year to 5 years. Is that a reasonable time horizon for you? And finally, what is the expected profit and profit splits? It is highly recommended to ask for the project model in Excel so the assumptions can be played around with. Start by looking at the sources and uses in the model. The sources tell us how the project is going to be financed, with a loan or loans, and with equity, and how much of each. You don't want the project to be overloaded with a loan. The uses will tell you what the project is going to spend money on: the purchase, acquisition, closing cost, hard cost, soft cost, and financing cost. The sources and uses must equal each other. Examine the assumptions tab carefully. Is there a term sheet from the lender? And if so, do these terms match the numbers in the Excel? For a renovation project, start by examining the current rental rates in the property compared to the market rents. Is there room for improvement? And also, once the renovations are done, what is the projected rent compared to the comps? Are they reasonable? Are they too high? Is there still room to grow? For ground-up development projects, what are the projected selling prices and how do they compare to recent market sales comps? Also, for new construction projects, it is important to know who is doing the construction. Is it done in-house or contracted out? Is the construction cost per square feet reasonable? Are there competing bids? In the closing costs, pay attention to what's going on there. What is hidden in there? What are the costs? How much acquisition fee is the sponsor taking? Examine the soft cost section carefully. What are the fees there? What is hidden there? Is there enough of a contingency cost there? When it comes to the operating expenses, are they reasonable? Compare them to the past 12 months. What are they projected going forward? Pay attention to the property tax line item. It usually increases by a significant amount after the first year of purchase. When it comes to the exit assumptions, compare the values used in the model to what's going on in the market. Is the cap rate reasonable? Is the price per door reasonable? If the values in the model are too high or too low, the valuation could be wrong. And finally, what are the profit splits the sponsor is offering? Usually there's a preferred return and a profit split thereafter. The profit split can be 50-50 or go up to 60, 70, 80 towards the investor and the balance to the sponsor. It all depends on their experience and what are they willing to offer to the investor. Of course, you can always negotiate for more. So there you have it, a quick overview of how to analyze a real estate investment. Stay tuned for more in-depth videos on the subject. Please hit the like and subscribe button and help the channel grow. Thank you for watching, and until the next time, have a profitable day.